What up, traders? I am Agbo Samuel Odi, the liquidity king and the AUD sniper trader, back on your screen. And in this video, we'll be talking about market manipulation. Now, have you wondered why you always get stopped out before the market goes in your direction? It's simply because of the logic and this concept that I'm going to be breaking down in this tutorial or lesson. So you really want to sit tight and listen to all the things that I'll be pointing out in this video, because it will aid your understanding on how to trade smarter and better. So now, what market manipulation is all about is stop hunt, right? Stop hunt is one of the most recent way the market operates, because why? The big banks, which are the major participants in this market, are orders are not easily filled compared to that of we retail traders. We trade with standard lots, micro lots, and mini lots in most cases, but these participants or big participants trade with very big lot size, and their orders are not easily filled compared to we retail traders. So what they usually do is they would take out most traders in zones where they know that higher chances and much stop losses are above. So they'll trigger price to trade above retail traders point of interest, and in turn stop them out before driving price in their intended direction. So now let's use market structure as a logic, right? Now let's say market is trading up, right? So in an uptrend, okay, let's go do that again. So in an uptrend, what do we want to see? Price creating higher highs, right? And also creating higher lows, right? And in a downtrend, what do we want to see? Price creating lower highs and lower lows, right? Lower highs and lower lows, right? This is simply what we look out for in an uptrend and a downtrend, right? So yeah, this is what we simply look out for when trading market structure, right? So now, always understand that at every price point that price move, there are either buyers pushing the market or sellers pushing the market, right? So for example, we can clearly see that at this point, what happened? Buyers push price, and where are their stops? Below this level, right? And at this point again, buyers pushed price higher again, and where are their stops? Below this level. So what it entails is that sell orders are below these levels, right? Because if you're buying one currency pair, you are simultaneously selling another. So what bigger participants usually do, since they know that this is an uptrend, right? Instead of to come and create a new lower low, what they will do is they will push price below these lows. Why? Because they know clearly that their load of buy or stop losses below this point, right? When they do that, then that's when you now see when all those guys buying here and buying here are stopped out, then you now see the next move going up to break structure, right? And that's the same thing for a downtrend, right? You see all these points here. What happens? Sellers stop loss are above it. So what bigger participants will usually do, they, instead of creating a new lower high, they'll push price higher to take out all these highs, right? Because why? Stop loss are above those highs before going down to break structure, right? So this is with structure, right? So now let's go to the chart and look for examples, right? So that we can look at the chart and see how these things really play out, right? So this is AUD USD, right? This is AUD USD. So let's say this, we consider this to be a high of the market, right? Which is what sellers got involved here and push price lower, right? Now can you see that when price came back, because this is a clear obvious level, you see that price had to go back and take it out before what, breaking structure to the downside. Can you see? This is simply because a lot of sellers stop loss are above this level. Those guys that sold from here, their stop loss are above this level. So what market manipulation or liquidity hunt or stop loss hunt is usually, price will trade above the level, as you can see, before pushing lower. Now let's look at another example, right? Now we are spotting them, right? In another video we'll learn how to trade them. What can we see here? We can see a support level, right? Or a low, right? An obvious low. Now can you see that this low right here traded up and created this high? Can you see that when price came back down, price had to take out this low, which is a stop loss hunt or a manipulative move. Now as you can see, price topped it out. What then did you see? Traded back up to create a new high. Because why? A lot of stop loss is around this place, so market will always go for them, right? So now in obvious sense, now the things you need to avoid in this market are equal highs, right? Always avoid trading around equal highs and always avoid trading around equal lows, because those are liquidity points. This low are liquidity point that market will definitely come back for before going up, and these highs as well are liquidity points, so market will always trade above it to take all those guys that have sold from this point out before going down, right? And also you can look at trend lines as well, right? An obvious trend line, once you see market trading up like this is an obvious trend line zone, right? So avoid them because market will always take it out before continue, and the same for this, right? So market will always go take it out before dropping. So always avoid trend lines and obvious levels. So now how do you take advantage of moves like this, right? Now all we simply want to do is understanding how to take advantage of moves. Now one of the ways you trade these zones is like this, right? You always, now once you see an obvious low like this, right? Let's say this is a market. Now once you see an obvious low like this, always know that that is a liquidity point. So how you trade it is you simply wait for market to come back to that point and see how it will react. Then when you see price takes out that level like this, then you just want to wait for candlestick to, if you see an aggressive candlestick that push price up and close below, then you just know that all those buyers that are here are stopped out, right? And there's a likelihood that price will trade up, right? So always wait for price to get to that level and see how it reacts, right? That's the first one. And see if it takes out the liquidity, and when it takes it out, then you just simply enter the market with whatever confirmation you're using. So let's use this as an example now, right? This is not really clean, but we'll use it, right? So now we can obviously see a high, right? And as you can see, what happened? Price took out the high, and as price took out the high, can you see how price aggressively moved back to tell you that okay, this was a clear liquidity sweep? And you can see here again, so there was two point of interest that price took out, and you can see how the next candle traded back aggressively to that zone. That is your confirmation. So when you wait for price to get to the level, first see if price trade above, then that's where you now look at candlestick formation, right? You can, in that level, look for reversal candlestick, bearish reversal candlestick. After price have traded above this zone, right, then you then look for candlestick reversal pattern. As you can see, we have a form of a morning star or an inside bar, right? So that is your confirmation. So if your entry should be below the third candle, right, after the form of this third candle signifying bearish present, then you sell off, right? And let's look for more examples, right? Now we can obviously see here again, right, a low that buyers got involved. Now we are trying to read how buyers and sellers interact in this market. So all the guys that bought here, where are their stop loss? Below, right? And you can see when price come back there, price traded below that level to take out all those persons. Can you see how price went aggressively up back again? So you looking at candlestick formation again, you can see that after that level was taken, you can find your entry, right? You can find your buy entry after the sweep of this low, right? After the sweep of this low here, right? So let's look for more examples so we know how these things really work, right? So yeah, okay, let's go lower, right? Okay, we can see a clear example here again. We can see an obvious high, right? An obvious high where sellers got involved. Can you see that when price went back there, it traded above? Because why? Those people selling, where their stop loss, remember, above. So price will always be attracted to those points. And can you see when it traded, can you see how the move was aggressive down, went aggressively down? So now one thing you need to understand is that when market stops people out, right, there's a lot of money in the market, or when stop losses are being taken, a lot of money will be available in the market. And when a lot of money is available in the market, that's when you see obvious aggressive move like this, right? Because a lot of persons are stopped out at this point, right? A lot of persons are stopped out. As you can see here again, buyers got involved, right? We had their stop loss below that level, and you can see that when price came back again, price had to trade below that level to stop all those people buying before the aggressive move up. So can you see that most persons are stopped out? Almost everybody buying here are being stopped out. So there's a lot of money in the market, so bigger participants can easily come in and make that significant move that they want to do, right? So now always remember, in the logic behind market manipulation is simply orchestrated by banks and hedge funds and bigger participants in this market, simply because a lot of their orders will not be easily filled if we retail traders and them are trading at large, right? So what they do is they go, or they manipulate price to stop most retail traders to make their money available in the market for them to push price for their order to be easily filled. Now, the things that you need to avoid while trading the market in order not to be victim is equal highs or obvious highs and obvious low. Obvious highs and obvious low are always the target, right? So don't trade where you can see that the highs are obvious, because That might likely be the target, and don't trade where the lows are obvious, because that might likely be the target. And also trend lines. When you see um trend line that has more than 3 touches, right? So let's say you see trend line that has more than touches, you might it might likely be the target, right? Or when you see trend line that has multiple touches, it might likely be the target before dropping. So don't trade obvious highs, obvious lows, and also trend line, equal highs and equal lows. Avoid those levels while trading the market. And I hope you found value from all that have been stated in this video. Kindly practice, backtest them. Don't just go and trade them, backtest them, look at the chart, and know and see how price reacts to these levels that have been stated in this video. And kindly like, share, subscribe to my channel, and hit the notification bell to get notified whenever I drop trading related content like this. And yeah, I will see you in the next video. And in the description box below, you see the link to join my free Telegram channel, where I post trade signals and ideas, building the biggest trading community. And yeah, I will see you in the next video. Peace out.